The euro came back under pressure in early trade after hitting a new daily high. In late trade, the European currency extended losses weighed down by statistics from the United States that pointed to a strong labor market. Data showed that U.S. initial jobless claims came in at 212,000 and changed from the previous week's revised level, which supported the dollar. The Federal Reserve Bank of Philadelphia's manufacturing index rose sharply in April, which fueled demand for the greenback. Yesterday's statement for the Fed officials also played into the hands of dollar buyers. Minneapolis Fed President Neil Kashkari said the Fed could potentially hold rates steady throughout the year. It is worth noting that earlier this year, traders expected the Federal Reserve to deliver 3 or 4 quarter-point interest rate cuts in 2024. The British pound also responded negatively to the statistics. Moreover, it hit a new one-month low during the Asian session. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. The US is set to release data on retail sales, which are estimated to have increased by 0.3% in March. Germany is scheduled to report data on producer prices, which are expected to remain unchanged. If the index is in line with consensus estimates, it will have no impact on market sentiment. Traders may also take notice of speeches by Bank of England officials. Given that the calendar is almost empty, the euro and the British pound will likely remain under pressure. Now let's move on to the technical analysis. According to the 1-hour chart, EUR USD, a false breakout at 1.0650 will generate a sell signal, thus dragging the euro down to 1.0605, the lower boundary of the sideways channel. If the price breaks below this level and tested for the bottom up, the volume of short positions will increase further. In this case, the European currency is expected to dip to 1.0569 and 0.545. At the level of 1.0545, I recommend going long on the rebound to catch an intraday correction of 20-25 pips. Long positions at 1.0605 and 0.569 can only be considered amid a false breakout. In a bull case scenario, if the price breaks through and consolidates above 1.0650, the euro will most likely rise to 1.0688. At this mark, it would be wise to go short on the rebound, expecting a 30-35 pip move. If the price climbs above 1.0688, the euro-dollar pair will have a chance to extend gains to 1.0726 and 0.754. Speaking of the GBP USD pair, the situation is the same. A false breakout at 1.2437 will create a sell signal with the British currency falling to the support level of 23.89. If the price breaks through and fixes below this mark, sterling will extend weakness, diving to 23.40 and even 23.04. At the level of 23.04, traders are recommended to go long on a rebound, counting on an intraday correction of 30-35 pips. Going long at 1.2340 and 23.89 will only be relevant amid a false breakout. Alternatively, if bulls take control of the market at 1.2437, the British pound will enter a bullish correction and advance to 24.82. At this mark, I recommend opening short positions on the rebound, anticipation of a 30-35 pip decline. If bulls push the price above 24.82, one can go short at the level of 25.32, expecting an intraday correction of 30-35 pips. Good luck and have a nice weekend.